Good morning or good evening, depending on where you are, of course, in the world. This is the Capital.com Market Mondays webinar. My name is Kyle Rodder. I'm with Danny Haythorne. We're both senior market analysts at Capital.com. Danny, good morning to you. How are you?
Good morning, Kyle. I'm good. How are you? How's everyone this bright and early Monday morning?
Bright and early is both the operative words here, so we may as well crack on. Danny, we'll start with the compliance slide, which is just to say, first of all, in Australia, that everything that you hear here is of a general nature only and does not take into consideration anybody's personal circumstances. Danny, you do the UK warning a bit better than me, so I'll hand it over to you
Yeah.
very quickly to knock that off.
Yep. Aside from that, this is just general market information. Be aware that the products that we do offer, so CFDs and spread bets, for those of you in the UK, they are complex instruments and they do carry a high level of risk. So just make sure that you are aware of the risks involved when trading these products.
Beautiful. So let's go through what we're likely to discuss today.
Yep.
And it's obviously fairly loaded. I'll kick things off just with a quick comment about the Middle East tensions. Obviously, Danny, that's kind of dominating the narrative to start the week. But of course, we're kind of coming off the back of what could be another big week focused on trade issues as well as some macroeconomic data as well.
Yeah, indeed. Markets towards the end of last week kind of focusing on this escalation of tensions in the Middle East, specifically between Iran and Israel, just kind of bringing back to the surface those concerns that this could be a wider region conflict, that it could escalate further. We've seen some comments from Iran saying that if Israel were to back down, they would be able to resume peace, but that seems to be getting further and further away with more attacks over the weekend. So we'll look at the markets in just a second, but of course that has caused a risk off sentiment, causing equities to drop, and then gold moving higher as a traditional safe haven. Interestingly enough, the dollar as well managing to reverse some of the losses on Friday, to also finish the session higher on the back of that narrative, and then oil, of course, seeing that significant surge in Friday's trading. Aside, as you were mentioning, the US and China continue to be at the forefront of market interest, but we did see the talks in London last week kind of fail to provide a material resolution or any forward move in terms of resolving the export restrictions. A lot of it having to do with national security and safeguarding their own interests. But the kind of feeling that we got at the end of it was that they just reiterated what they'd spoken about in Geneva a month prior. So not much progress there, and we saw markets a little bit disappointed on the back of that. It's going to be a very busy week this week in terms of central bank meetings. We've got the Bank of Japan, which no change expected to their rate, but they are talking about considering easing the level of reductions they're doing in their bond buying program. I think they're going from about 400 billion to half that, or that's what they're considering. We also have the Federal Reserve, which is expected to keep rates unchanged again, which has been the main theme throughout the 6 months of this year so far. And then, of course, we also have the Bank of England meeting on Thursday. We'll have the UK CPI on Wednesday, the day prior. So that will be significant towards that. That's pretty much it in terms of the headlines. I think there's quite a bit to cover, from geopolitical to trade and also central banks. So I think let's get right into it. Otherwise, we're going to be dragging this on too long. So let me just pull up some charts. If you want to take it away, Kyle.
Yeah, certainly. Well, obviously, we may as well just give a bit of an overview and discussion about the implications of this inflammation of tensions in the Middle East. Obviously, came at the back end of last week and caught markets by surprise, despite the fact that, well, initially, a few days beforehand, markets became a little bit volatile and nervous on reports that the US was removing key diplomatic staff from some major embassies in Iraq. But even prior to that, and there was rhetoric from the Israelis that it was preparing a strike on Iranian nuclear facilities, which, to be honest, is not something that is uncommon and has been a threat made over the last, several decades. perhaps certainly in the last decade or so that was not unfamiliar to market participants. But nevertheless, on this occasion, obviously it came to fruition. It caught markets slightly off guard. So the implications of this are obviously sort of multifold, if you will. The initial thing for market participants is that war risks are very difficult to price in. Trade policy, fiscal policy, already complex enough, but in principle, you can kind of quantify the damage if you know the numbers. With war, it's very, very difficult for markets to understand the very dynamic and complex nature of how this will unfold. So there's a degree of probably shoot first, ask questions later, perhaps a somewhat unfortunate analogy there for market participants, but also this could obviously get a lot worse if it spirals into a regional conflict that possibly draws in other major players. The United States is obviously the key actor in question here, and that's certainly not discounted into the price. What is a little bit more quantifiable, of course, is really the impact on energy markets, and naturally the cause of, or the reason that this latest round in the conflict, if you want to call it that, sort of assuming that what's been happening in the Gaza Strip is roughly a proxy war between Israel and Iran anyway, is that this could lead to fairly significant disruptions in global energy markets, because this is all about targeting Iranian nuclear facilities, which obviously we're taking the US and Israel at its word in terms of its kind of, what would you say, need for immediate action here, but that Iran was on the cusp of being able to produce its own nuclear weapon, and that was obviously unacceptable for powers in the region. So we're looking now at a market that's an energy market that's highly nervous, because over the weekend as well, we've seen the Israelis target Iranian gas infrastructure. The Iranians have threatened to cut off the Strait of Hormuz, which is a very key sort of, I guess what's the word?
Shipping route.
Shipping route, thank you. Shipping route for the global economy, which could significantly impact global energy markets. And just as an aside to that too, there is the notion that Iran has had sanctions imposed upon it for a very long time, and therefore its oil has been removed from global markets for quite some time. That's not really the case, because the sanctions that were applied by the United States and some of its partners on Iran have either been ignored or circumvented through other means. So this would cause a pretty material disruption in global energy markets, which would be both a supply shock, or would be a supply shock, in fact, impacting demand globally and on aggregate, but also would have an impact on prices too, because of the way oil influences inflation. So that's kind of the state of play at the start of the week now, Danny. And again, like I said, markets find it very difficult to price these things with any level of confidence, but it's simply causing a bit of a sell-off in equity markets as investors sort of survey the damage and survey the situation.
Yeah, as you were saying, the energy market is likely to remain volatile this week. We've had reports from gas refineries being targeted, but also oil refineries and Iran's nuclear facilities. So expected to see continued volatility in the equity market this week. So far, oil actually dipping from that surge that we saw on Friday. In the meantime, natural gas also dipping a little bit from that jump higher earlier this morning. So clearly investors focus on the energy market, as we were saying, likely to be some further disruption there. And of course, equity markets as well, dipping lower on the back of that on Friday. Interestingly enough, and this leads us into the next point, equity markets were already trending to the downside last week. You can see here the DAX, for example, already starting to see that turn to the downside here on Monday, attempting to build this morning, but clearly a bearish week last week. We've got pretty much the same momentum here in US equity markets, maybe not starting so early, but clearly seeing that downside intonation there. Now, For European markets, or I think in general, the sentiment in markets, as we were saying, those talks between the US and China failing to provide any material resolution. I don't think expectations were very high or realistically. We know that trade um, discussions take months and years and not days and weeks. So I think it was naive for anyone to think that, the US and China kind of stretching arms and getting together and making an effort to try and resolve these issues would result in an immediate trade deal. But I think they were expecting potentially a little bit of a move forward from the initial talks in Geneva. We actually haven't seen that happen. We kind of just got the same reiterating message that they are working closely together to try and resolve some of these issues. A lot of it having to do with intellectual property and also with national security and protecting their own interests. But the two greatest nations, or the two biggest trading nations in the world, are likely to do that. They want to preserve the competitive advantages that they have, and they're unlikely to give those to relinquish those easily. So it's likely that this continues to drag on. We could see positive developments in the process, but a clear, firm trade deal or an end to these export restrictions, for example, will take some time and some finessing. And I think markets just reacting on the back of that, a little bit disappointed from the lack of, I guess, progress in those trade talks. In fact, one comment from China that I remember last week sparked a little bit of downside volatility was China saying, I can't remember the exact words, but something like they don't wish to escalate things further, or they don't wish to fight, but they are prepared to do so if they need to. So just kind of reiterating the fact that they are open towards finding a mutual common ground, but they're also ready that if things go south, they're ready to also fight back. So I think that just reminding equity markets that this is actually a process that's going to take a long time, and that things could go south in the process. It doesn't mean that we're going to end this period of negotiation with a clear established trade deal. It might be the case that they realize along the way that, they have more differences than similarities at this point. So that was affecting a little bit of market sentiment. And we did see also the US CPI data last week actually coming in below expectations across the board, both on headline and core, with energy dropping as well. So again, just adding to that feeling of, there's still a lot of uncertainty out there, and that should have helped equity markets recover a little bit. And I think that's why the US stock market was a little bit more firmer last week compared to, for example, Europe or Asia, on the back of that softer inflation data, providing a little bit more hope that the Fed could cut rates at some point, but clearly not just yet. Kyle, let's go over to you first, because we do have the Bank of England, I believe, tomorrow on Tuesday, overnight for us here in Europe. What are your thoughts on the BOJ and their thoughts about their bond tapering program?
Yeah, so just a little bit of context. Effectively, we've seen a lot of upward pressure, especially on the long end of the yield curve for Japan, and this was brought to a head a few weeks ago, maybe about a month ago now, with a rather weak 20-year auction for JGBs, which sparked these kind of concerns about funding pressures in Japan, and that perhaps there's some fairly significant indigestion in the Japanese bond market, by virtue of, first of all, policy that needs to be tighter going forward, because we're seeing inflation successfully re-anchored, obviously, by the BOJ, well above target now. But admittedly, from them, that in a context where policy is still too loose, real yields are still quite negative. So in theory, policy isn't being run restrictive enough. So investors are wanting compensation for higher inflation expectations. But of course, too, we have been seeing that the Bank of Japan for quite some time now have been drawing down their balance sheet in an attempt, obviously, to also add a level of restrictiveness to policy. And that, when you add the fact that we've got some other significant factors in the global economy, like US trade policy, US fiscal policy, and of course, German fiscal policy as well, which we've spoken about it in the past, putting upward pressure on yields, it's leading to this dynamic where policymakers are rather concerned that there could be some fairly significant dysfunction in the very, very important Japanese government bond market. And that's also had ramifications for the rest of the world. I mean, the Japanese situation has also contributed to upward pressure on yields in sovereigns across the globe. But it's also likely had some kind of dulling effect on equity prices too, because it tends to have the effect of sucking capital back into Japan, rather than Japan being sort of an exporter of capital as it has been for such a long time, and being sort of a marginal driver, or at least a supporter of risk assets across the globe. So because of the uncertainty that we're seeing prevail in trade, and that kind of difficulty for policymakers to be able to set policy settings appropriately or providing guidance appropriately, it's likely to be the case that this is once again a situation where policy is on hold, and when it comes to the actual macroeconomic outlook, the Bank of Japan are going to take a fairly cautious approach to guidance, but this will be about how they manage some of the potential pain points in the bond market. And effectively, the equation is that if the taper is reduced by more than expected, Japanese equities would struggle under those circumstances, and the yen would probably appreciate. Whereas if it's a slightly less aggressive taper, then the opposite would largely be true. So effectively, it's all about if the Bank of Japan is more aggressive in its or not as aggressive in bringing back that taper, that's going to be a volatility event that could spill out for the rest of the world, and cause a little bit of risk aversion. Certainly in Japanese markets, but once again, there may be spillover effects.
Yeah, the bond market has been driving a lot of the momentum recently. We'll go back to that thought of bond vigilantes kind of coming back, and trying to put governments in check and fiscal policy in check when it comes to debt ceilings. And specifically in the US, we also had that same scenario where we had some pretty poor bond auctions that kind of resonated with the fact that investors were just wanting to show their discontent with the fiscal policy in the US and the level of the debt. Interestingly enough, last week we had two bond auctions that were actually pretty good. We had a 10-year and a 30-year. So we saw yields rise on the back of that, and then also that moving into the expectations from central banks. But we can see here in the 30-year, we had a positive session last week at the back of that bond auction. And then also with the 10-year yield, I believe is this chart. Yeah, the 10-year yield here as well, moving higher towards the end of the week. So we've got kind of that same scenario with the US, but here we have the opposite in terms of considering further easing. Now, as I was saying earlier, that softer US CPI data did enable markets to try and price in a higher chance of rate cuts earlier this year. I believe it's currently September or so. But all in all, the preview of the Federal Reserve is just, we're expecting to see no change in terms of the key rate. The key for markets, for the US dollar, for US equities, is going to be the messaging from Powell in terms of forward guidance. Again, he's likely going to be quite restrictive and quite conservative, which how much he says. But it's also the meeting that we get updated economic projections. We get the dot plot, and the dot plot has been watched quite closely in recent meetings. Kind of just that visual representation of, how individual policymakers expect rates to progress over the next few months and the next few years. I think that the median forecast, the last one that we had, was in March, and that was showing, I believe, two rate cuts in 2025. Expectations again could shift with this dot plot, and that's where we could see a lot of the momentum in equity markets and in the US dollar. So yeah, closely watch that dot plot, closely watch those projections. Has inflation, has growth changed at all? And I think one of the key issues with the Fed is, how do they price in the shock from tariffs on inflation? Now, Powell and his team have been very criticized and how they mislabeled inflation in the initial of the COVID aftershock. Powell saying for a long time that inflation was transitory, and that it wasn't gonna affect markets or the economy that much, because it was a one-off shock to the economy. That, of course, proved to be one of the biggest mistakes that Powell and his team have done in terms of labeling inflation transitory for so long and being too slow to react in the hiking process, that they've definitely taken the different approach this time around, and they've been more cautious, making sure that they have visual confirmation that inflation has softened before cutting rates, and that's why they're lagging behind so much other countries like the euros, like the eurozone, or places like Australia, Canada, all these other developed economy that have cut so much more in the last 12 months compared to the Fed. And that is because I think Powell and his team don't want to make the same mistake of not focusing on inflationary pressures. And yes, the shock from tariffs are expected to be, in this case, transitory and one-off shocks to the economy, but I think they're not taking any risks on that. And given that the economy continues to show resilience in the labor market, not so much on the growth data anymore, but to some extent over the last 2 years, growth has been significantly much higher than other developed economies. They do have a little bit more margin, which has been diminishing in the last few months, I do have to say. So it could be coming towards the end of the line of that safety period, that grace period that the Fed has had because of the strength of the US economy. And now it's when markets expect more action. But again, inflation has cooled, but not enough, I think, to justify cutting rates. And this takes me to the dollar, because you can see here, even though rates in the US are so much higher than in other developed economies, let's take, for example, the Eurozone, the US dollar has struggled to find some bullishness. And rate differentials do say that, or the way rate differentials work is when one country's interest rates are much higher than others, you would expect that domestic currency to strengthen. That hasn't been the case for the dollar. And that kind of alludes to the complicated situation that we have with tariffs, where the uncertainty that tariffs have brought hasn't allowed the dollar to take advantage of that stronger differential. And that's clearly visible in the US dollar index. But also, if we're looking, for example, at euro dollar, we can see the continued strength in the pair here, even as the Fed, even as the ECB, the European Central Bank, has continued to cut rates progressively over the last few months. Euro dollar has continued to move higher. And again, this alludes to the weakness in the dollar's potential and people's confidence in the US economy and the US dollar. So that is a very interesting dynamic. I don't know, Carl, if you have anything to add on the Fed before we move over to the Bank of England.
No, only just to distill what you were saying, I suppose, which is to say that, it's going to be about the guidance, and in particular the SEP. There was talk that maybe the Fed would raise its dot plots slightly. There was, I guess, some level of hope, I guess, with the March SEP, I believe it was, where the Fed signaled that it would continue to cut rates effectively 2 times, or thought it would cut rates 2 times this year, even though inflation was expected to spike to around 2.7%. There's a bit of a divergence potentially in that narrative with what's going on in the rates markets, which is to say, like you said before, Danny, that rates markets are pricing in now after last week's soft inflation data, 2 cuts before the end of the year. If we get a fairly cautious Powell, a Powell that's still concerned about the uncertainty generated by trade policy, and maybe now some of the uncertainty generated from what's happening in the Middle East because of its impacts on inflation, and doesn't really lend itself, the language doesn't really lend itself to those 2 cuts. That might be a slight volatility event, because those cuts are currently in there. Upgraded inflation forecast and a higher dot plot again would kind of compound those concerns about interest rate cuts not coming through. So it'll be it's not a live meeting, but there's still plenty there that could spark a bit of volatility based on the guidance, the uncertainty about how the Fed's going to approach its guidance.
Yeah, and just to finish off before we look at some of the questions, we do have the Bank of England meeting on Thursday. No expectations, expectations for no change there as well. Rates to remain unchanged at 4.25%. I think this is because we have seen a recent cut from the Bank of England, and headline inflation actually rose to 3.5% in April, which is a significant move from the prior reading, but also well above the 2% target once again. We do have CPI data on Wednesday, the day before the meeting. I've seen a few expectations projections, some of them suggesting that the headline could remain between 3.5 and even go up to 3.7, which is actually the Bank of England's long-term, well, the Bank of England suggested that inflation could creep up to 3.7 before moving lower, and that was expected to happen in Q3. So that could be bang on with Bank of England forecast. Some other forecasts by economies suggesting a mild easing towards 3.3, 3.2%, but nonetheless still significantly above that key 2% target. And specifically, private sector wage growth has remained strong and is one of the key inflation concerns from the Bank of England. So that's why no expectations to see a rate cut from them. The economic picture in the UK continues to present, I think, a mixed picture. UK GDP shrank 0.3% in April. We saw that data last week. That was more than the 0.1% decline expected. A lot of that was attributed to the negative impact from US tariffs and also that increase in national insurance contributions, which were unveiled in the budget at the end of last year. But nonetheless, significant, again, that mixed picture from the UK. The economy continues to struggle, but inflation is high. Once again, the UK, one of the I guess the highest contenders for a risk of stagflation. And I think that's why the Bank of England definitely expected to keep rates unchanged this week. In terms of market reactions, if we do see the base case scenario, so a hold on rates, especially if forward guidance has, I guess, a cautious tone, I think when you get a neutral, possibly a mildly hawkish tone from the Bank of England, just reiterating the fact that they are data dependent, but inflation risks continue to the upside, then that could support the pound, especially if we're looking against the likes of euro and the dollar. So for example, here you can see cable, again, that dollar weakness providing a lot of the catalyst for this story. But again, we could see cable push above 136 if we do get that cautious but mildly hawkish tone from the Bank of England, which could help the domestic currency regain a little bit of the upper hand. Of course, that would potentially lead to a rise in gilt yields in the UK, and also weigh on UK equities, so the FTSE. Alternatively, if we were to get a dovish surprise from the Bank of England, expect the opposite, a downside pressure on the pound and yields and some upside for equities. And then if we were to get, I think this is the least case scenario, a hawkish tilt. So not only, showing some mild concern for upside risk in inflation, but actually, highlighting persistent inflation and potentially or pushing back further on rate cuts, then we could see specifically the pound and yields moving higher. But again, that is likely one of the least case scenarios. But again, an interesting meeting from the Bank of England, but not much expected to change given that there's so much uncertainty still out there. And I think stagflation continues to be at the core of the concerns. Kyle, I think we've got some questions, one of them being one of our favorite assets, as always, on gold. Updates on gold. From my side, again, we've seen that resurgence in safe haven demand on the back of issues, geopolitical tensions. We saw that towards the mid of last week, that move higher. Clearly found some resistance just around that 3,000, just below that 3,500 level, which has been a key area of resistance in the past. Interestingly enough, silver, which has been surprisingly strong last week. You can see here how strong it's been since the beginning of June, dipping lower towards the mid of last week. That was, we saw that shift from silver to gold, that gold silver ratio increasing towards the middle of the week. Again, I think silver has been a great proxy to trade. I guess geopolitical tensions remaining in the background, but also improving sentiment in markets. So in the way that gold is such a safe haven, traditional safe haven asset, silver pulls that safe haven aspect into it, but also it's used in industrial processes. It does mean that it has a lot more sensitivity to economic developments. So I think given that risk on or the risk sentiment in markets had improved significantly since the beginning of the month, with equities moving higher. I think silver was pulling in both that improved sentiment in general in markets because of the industrial aspect of it. Also with the fact that there's a shortage in silver that has been going on for a while now, and it recently come to light, which has been driving again a lot of the tightness in the price, but also that safe haven aspect to some extent also pulling in. But now the markets have kind of left that improved sentiment rhetoric behind, clearly with equities, as we saw towards the end of last week, and are focusing more on geopolitical tensions. Gold has overtaken silver once again. We've seen that dip in silver and that move higher in gold, which in my view is likely to continue. You can see here from the technicals, the RSI avoiding dipping below that mid-level and now regaining that upper hand. Again, this morning, those sellers attempting to put some downside pressure, but I think in terms of the short term, we could be in for some further upside. What do you think, Kyle?
Yeah, I still think structurally gold's in a bull market, and I think all the tailwinds at the moment are pointing in that direction. Trade, US fiscal policy, now geopolitics as well. And if we still see sort of US inflation data coming in on the low side, while growth also weakens a little bit, certainly converges with the rest of the world, US growth converges with the rest of the world, and that leads to a weaker dollar, then that's going to be supportive of the gold price ultimately. And then there's that kind of structural story of de-dollarization, I suppose, too, that has probably underpinned the structure of this uptrend. So hard to disagree with you, Danny, that in the long run this looks fairly constructive. Interesting that we did sort of sell off again at basically resistance around, call it 34.30, 34.40 or so. We want to see a consolidation above 3,400 because that's where sellers have basically controlled the price in the past. We had that melt up to 3,500, but it didn't stay up there for too long. So there are signs of exhaustion there in the short term. And the things that could sort of turn that around might be a fairly hawkish Fed, or it might be a trade policy breakthrough. We'll have to see. But ultimately, I still think gold looks, good in the long run. It's really hard to argue for a bear case for the time being in the bigger picture, just because, like I said, everything's kind of, all the tailwinds are sort of at gold's back at the moment.
Well, I think, Kyle, we've come to the end of the agenda. We've answered some of the questions that we had as we were going along. So from my side, I think that's pretty much very interesting week, as we were saying. A lot of on the geopolitical front. So a lot of volatility, as we were saying, on energy markets, but also equities likely to see further downside pressure if tensions continue to escalate, and that worries markets even more. And of course, the three central bank meetings that are pretty key this week, likely to also provide some volatility to the FX space. So from my side, thank you everyone for joining again, and we'll see you back on Monday. Kyle, bye bye. See you again next Monday.
Have a great week. All.
Bye, guys.